Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Dell reported fewer sales of AI servers, lower profit margins than expected. That's really taken a toll on shares. They're down about 9%. So we want someone who could break it all down for us. Let's bring in Jin Ho, Bloomberg Intelligence Senior Technology Analyst, joining us from Princeton. Jin, welcome back to the show. I want to start broader. So taking these results into consideration, I mean, is it showing that the AI rally has more room to run or not? I mean, what are you hearing?
In terms of the AI rally in general, I mean, we saw Nvidia's numbers, and Nvidia is actually doing quite well. I mean, if you X out the China outlook, right, the demand is still robust. And this actually flows through to Dell. If anything, the AI numbers for AI server numbers were better than expected in the quarter, and they also raised their guidance by another full year guidance by another $5 billion. So instead of $15 billion for the year, they're expecting $20 billion for the year. And as more of these sovereign and neo cloud deployments start ramping up, 2026 AI server revenue should be better for Dell, given how they're positioned.
So then, can you try to explain why this stock is down 9%? I mean, Dell just said it now plans to ship $20 billion of artificial intelligence servers in fiscal 2026, double what it sold last year. What is upsetting investors?
Yeah, so there's a couple of things. Let's start on the AI server piece first. I've always said, and Dell will contend to it, having AI sales is a double-edged sword. What you're getting in sales, you kind of lose out on gross margin. So let me give you an example. From a gross margin standpoint, traditional servers as well as storage combined are roughly in the the 20s to 30s range, right? AI servers, they're closer to the mid-teens range, right? So from an operating margin standpoint, it actually is somewhat earnings dilutive to some degree if you sell way too much AI servers. So, the 1.2 billion AI server beat, that only equated to 2 cents in an EPS. So what Dell has been saying for quite some time now, don't focus on operating margin because that's where they missed. Focus on the operating margin dollars. That's fantastic. But the incremental $5 billion for the year isn't going to be the big boost in EPS that people are hoping for.
So, Jin, is a big concern for investors, is that the profitability of AI servers? I mean, they run on processors from companies like Nvidia and AMD, right, which are pretty pricey. I mean, should they be worried about that?
Well, the hope is that once we start moving away from these hyperscale and neo cloud type of deals, right, because they're selling 50,000 servers plus to each of these companies. They're not going to get as much. They're heavily discounted. But if they start selling to the enterprise over time, the gross margin profile should get better and be more in line with traditional servers. Now, that's going to take a couple of years to materialize. But the more important thing is if we think about it from a longer term perspective, as long as Dell is ahead of, from a competitive standpoint, they should continue to win this AI game, not only on the neo cloud side, but also on the enterprise side, which should help profitability longer term. But you're going to have to wait.
And, when I did a little more digging into this earnings report, I found that Dell spent $1.3 billion on share repurchases and dividends during the quarter. That's an enviable position to be in. But do you think it's the best use of Dell's money?
Well, so I think they've always been since they came back to public and then spun off the VMware business. They've been very focused on shareholder returns, right? Now, if you think about from a valuation standpoint, M&A is probably going to be something that's going to be tough for them to do. They've already learned a lesson from big M&A with the VMware deal, and which is one of the reasons why they spun it out. So if from a shareholder standpoint, if there's nothing that Dell can buy, I'd rather have it back in dividends and buybacks.
How is it shaping
Especially
up?
like a day like today.
Well, yeah.
Oh, yeah.
How is Dell shaping up against its competitors? Let's say like a HP or Supermicro
Yeah, so let me take it from two standpoints, right? From Supermicro, we're thinking about it more along the lines from AI servers. Supermicro still leads the way in the AI server market. Now, one of the things that we can glean from the numbers is that Dell has been heavily discounting to win its market share, and they actually have the financial heft to do so with a strong balance sheet. Now, from an HP standpoint, this is more personal computing side, and this is another reason why the shares may be pulling back a little bit. Their PC growth, that segment only grew 1%. In contrast, HP grew 5%. So there's a lot of questions in terms of the competitive nature for Dell versus HP on the PC market. Now, that being said, what we can glean from the guidance, the second half of this calendar year, HP should get back on track from back-to-school spending as well as Windows 11 upgrade. So I think they should do about 5% growth in the second half of the year.
And in the seconds we have left, can you tell us how Dell is stacking up against the competition, namely HP?
Yeah, so from PC standpoint, from HP, HP is actually winning the game over the last couple of quarters, but it's going to be neck and neck over the next couple of years. But from an AI and a server standpoint, Dell should be fine.
And in the last minute we have, where does Dell go from here? I mean, what should their focus be?
Oh, I really do think it should be on the traditional server side as well as storage side with AI, because they're all going to be melded into one type of business going forward. And Dell's well positioned there longer term.
Stay with us for more Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the big movers today is Caterpillar, a mover to the downside, that is, off nearly 4% right now. It's warning investors that tariffs are expected to have an even greater impact, take an even bigger bite out of its bottom line, expected to cost Cat as much as $1.8 billion this year. Let's dig into it a little more with Christopher Ciolino. He is Bloomberg Intelligence Senior U.S. Machinery Analyst. So what is it about this report that's got investors in a tizzy?
Well, you're right. I mean, tariffs will be a bigger cost headwind this year, more than Cat previously expected. And the revision really seems to be driven by additional clarifications around the Section 232 steel and aluminum tariffs and some of the reciprocal rates on India. As you alluded to, Cat thinks these tariffs could be, up to a $1.8 billion impact in 2025. That's up, 200 to 300 million versus their prior view, so a little bit higher. Even though that we're looking at these incremental costs this year, we think it's pretty easily digestible for Cat, and probably represents, the peak headwind that we'll likely see. They really haven't implemented significant cost mitigation or pricing actions yet. I suspect you'll see more of those measures in 2026, which could ultimately offset these impacts.
So, Chris, is it steel and aluminum? Is that the main focus?
Yeah, we think so. So we did get an update on the Section 232 tariffs for steel and aluminum that expanded the coverage to, I think an additional 400 different products. So, we had Cat report earlier this month, and we had that subsequent update. So I think that's probably the big driver behind it. Obviously, heavy machinery companies use a lot of steel and aluminum. It's their largest input cost. So that certainly does move the needle.
We're talking about headwinds, but what about tailwinds? Any of those for Caterpillar?
Yeah, despite some of these near-term cost headwinds, I don't think it really ultimately changes the narrative here. We're still quite optimistic that earnings are going to bottom this year. There's a number of cyclical and secular tailwinds that we think are going to drive higher earnings in 26 and 27. The backlog is sitting at a record high. We've seen very solid order trends these past, 4 quarters, and dealer inventories remain at pretty healthy levels considering the softness in the broader economy. So all of these are really positive leading indicators for Caterpillar.
And Chris, you follow this company very closely. So when we have an economic slowdown, what segments of Caterpillar's business tend to hold up the best?
So right now, the segment holding up the best would be their E&T or energy and transportation business. And really, I think the big driver behind that is power generation, particularly on the data center side. Those are much longer cycle products, have a very extended backlogs for many years. Caterpillar's adding capacity there. So we've seen that business hold up very well. On the flip side, the more cyclical construction industries business is probably the one more harder hit. And also their resource industries business, which is a lot of mining equipment, that's been a little softer as well. But I think if we're looking at a lower rate environment moving forward, we're certainly a little bit more optimistic on some of the growth prospects in those two businesses moving forward.
Stay with us for more Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Nvidia and AI, it was out with earnings this week, and it impressed with more proof that AI spending continues to be strong. I want to talk more about AI in the real world with Bin Ren. He is founder and CEO at the software company SigTech. He joins us from London. Bin, thanks so much for being with us. Before we get into SigTech and what you do with AI agents, we'll get into what all of that is. I just want your thoughts on Nvidia's earnings report this week.
I think we are seeing unprecedented demand for AI services, AI inference. If you look at the, not only the hyperscalers purchasing GPUs and building data centers, it's keep going up. And if you look at the consumptions of tokens by large language model providers such as OpenAI and Google and Anthropic, it's growing at 100% every 6 months. So the adoption, the usage, the consumption is all going up. The trend, there's no reason why it's going to slow down or certainly not stopping.
Ben, we've heard a lot about different types of AI. Gen AI is a huge one. I mean, I know everyone's on the Chat GPT or whatever else you have. But do generic AI tools, they can help out in a lot of fields. But what about financial institutions? I mean, you focus more on custom AI. Is that correct?
Yeah, we focus on building entirely bespoke and custom AI agents for customers in capital markets. I think people now, hundreds of millions of people have used ChatGPT, so we all have a good idea of what a chatbot can do for us, which is extremely useful. But when it comes to businesses, there's an increasing gap between what the large language models are capable of and what actually value users in businesses are getting out of the applications using the same models. The large language model capability has been improving dramatically, and frankly, probably the most improved applications, unfortunately, have been restricted to only a few areas, mainly about writing code. That has been the killer app outside chatbot. In finance, the difficulty is actually there are many different reasons why the application is not delivering the kind of potential we are expecting. One of the reasons is in finance, we use a lot of private data. The large language models are mainly trained on public data. Then there's the question of how to converting the vast corpus of financial documents in PDFs, in Word document, in Excels, into the right formats that actually can be effectively used by large language models. Any error in this data conversion, document processing pipeline will immediately result in very poor qualities downstream. And in other areas in finance, we crunch numbers. And the large language models are very bad at crunching numbers, right? And it's probably the most expensive calculator we can think of. So to make large language models work in finance, we have to provide a very wide range of financial tools. These tools can be softwares, can be APIs, can be desktop applications. Mm-hmm. Then we have to train models to use them. And there are other challenges too. Yeah, that's why everything has to be bespoke.
Ben, we keep hearing that AI is going to be a job killer. And we're already seeing it, frankly. A lot of, entry-level positions being taken over by AI. That means a lot of recent graduates from college are finding it even harder to find a job. And unemployment amidst that demographics about 6% right now versus a little more than 4% for the rest of us. So how do you see the future of work looking, and how does AI play a part?
I think wherever there's, unprecedented new technology coming along, so transformative and so disruptive, like AI, but previously there was internet, there was industrial revolution, there was the invention of airplanes and cars. I mean, inevitably, some jobs will be killed, I guess you can say that, but there will be new jobs created. I think the key here is to understand fundamentally what AI can do and what AI cannot do, and what makes us, by us, I mean humans, special. AI is very good at doing repetitive, non-creative work, non-creative knowledge work. Humans, we are uniquely equipped to be creative and imaginative. And also, by the way, you probably know that AI is really bad at telling a joke, a good joke. And there's a reason for it. Because AI is trained to predict the next most likely word, the word by word, and to deliver a good joke. And the punchline has to be surprising and witty. So it's large language models are literally not trained to be able to tell a good joke. So all the comedians, their
they have
jobs
to
are
write
safe.
their own stuff.
And they have to write their own stuff, and they have to have inspiration. They have to have new experiences, imagination, and creativity. I think that's probably a good role model for the future work look like. We can spend more time on being imaginative and creative, and frankly, more intellectually satisfying, and less time on things, frankly, we don't wake up and be excited about.
Stay with us for more Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Want to switch gears for a minute and talk about the sleepy summer for the housing market. Would-be home buyers, we know they've been staying on the sidelines. They're waiting for mortgage rates to come down. They're waiting for housing prices to come down. So will they? And when? Bess Friedman, she's been looking into her crystal ball. We called her in for some help. She's CEO at Brown Harris Stevens. Bess, always good to see you. Thanks so much for joining us. So let's just start with a reality check. Are things improving? I mean, I heard that inventory was starting to beef up a little bit. So are you seeing some pockets of improvement?
It's interesting. Good morning. So nice to see you as well. Thanks for having me. I think we see a step forward and then a step back. And I would describe our housing market, at least through the summer, as very frustrating. Buyers and sellers couldn't get on the same page. For buyers, things have become unaffordable. Rates are too high. Sellers aren't budging on their prices. They're taking their homes off the market. So there's been a little bit of that, and it's gradual. We definitely performed better this year than we did last year. It's a better housing market. But having said that, it's going to take a little bit of time. And I know that everybody's expecting or thinking that the Fed is going to cut the Fed fund rate in September. Maybe we'll have to see how the jobs report comes out. But, even that, I don't know that's going to have a dramatic impact. It's going to take time for us to come to a better place where we see supply and demand intersecting. That's a healthy market. And we don't really have that.
Bess, I have to tell you, I've been kind of caught in the middle of all this. I mean, I was trying to find a home. I've been outbid by like $170,000 in New Jersey. I mean, it was rough. So can you break it down as far as areas of the U.S., right? What areas are homes selling at a faster pace, or maybe what areas have more inventory?
I mean, every real estate market is so local. I'm sorry that you had that experience.
Thank you. I'm still getting over it. But
there are areas. I'll give you an example. A market that is completely on fire, there's no inventory and there's bidding wars, is upstate New York, Rhinebeck. You can't find anything. Whatever comes on, there's a bidding war, similar to what happened to you in New Jersey. Places like Montclair, New Jersey, very popular, a really strong market. And, people get discouraged when they walk in, they see 20 people there waiting, and then they know there's going to be multiple bids and rates are higher, price is now going to be higher. And so, that's very tough, but that's more the exception to the rule. Palm Beach is similar, but other places like New York is a pretty steady market in New York City right now. The market has been decent, not great. The rental market, really strong. That's all I hear about is people cannot afford to rent in New York. There's no vacancies. So it really depends on what's going on with supply and demand in the market. Like in Connecticut, for example, also really strong demand and lack of supply. And so we're starting to see more inventory come on. And so that's a good thing. And so hopefully if we get a little bit if rates come down a little bit, they have come down a little bit, that might inspire more buyers to get into the market. But it's tough. I'm sorry that you had that experience. In due time, something will come on that you love and you will find it and you will bid on it.
Bess, I want your thoughts on a trend we're continuing to see grow, and that is corporations backed by private equity groups now buying up single family homes. So folks are not only competing against other would-be home buyers, they're competing against the big guns, these institutional investors. I saw this one report from MetLife Investment Management. Get this, they say institutional investors may control 40% of the single family rental home market by 2030. How's a little guy supposed to compete with that?
That's really hard. I don't know. And we have a housing shortage in the United States. We need to build, we need 4 million homes here. So I don't know. That's not a good sign because people find that they can't afford rent, they can't afford to buy. And so we need to figure out ways to work together with our state and local officials to make rules and legislation that makes sense so that people can afford to buy and can afford to rent. And so, the little guy matters. We have to make sure that everyday people can afford to pursue their dream, which is to buy a home or to rent their home, whatever it is. It's really important. And we've lost a little bit of that in the last 5 years. And I would love to see that switch direction. I'm happy to be part of those discussions.
And Bess, in the last minute we have here, how are the builders doing? I mean, how is the sentiment among the builders who are building these homes?
It's a great question, and it depends. I'll give you a real example. A few months ago, I was working, friend of mine, builder, developer, New York City, was looking at a site, very excited. He wanted to buy the site to develop it, and then the primary came out, and it looks like, and what your politics are, I don't care, but it looks like potentially Mamdani might win in New York. It's a possibility. And so he got squeamish and backed away from it. And so, but another developer came in and ended up buying the site. It just really depends. People are very emotional when it comes to these things, and it depends how they feel. If they think the market's going to be good or strong, they'll invest. And builders are the same. It's pencils down. If they think legislation is sloppy and not helpful and not giving them incentives, they're not going to continue to build. So it's such a nuanced story. So we're seeing some builders do things, some stay on the sidelines right now.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.